Hi, and welcome to your tutorial. I'm Nab from mockexam.ca. You may know me from my mock exams or my famous IFC tutorial. Well, I did have lots of requests on preparing a good tutorial, a very solid tutorial on CSC, and here we go. We do have one. First of all, thank you very, very, very much for your trust, and I'm sure you won't regret it. Before getting serious, please don't mind my glasses. It's not for look or beauty. I do have a vision problem. Actually, I'm legally blind. I do have 15 to 20% vision left. And that's why I have to wear glasses because my eyes are super sensitive to any types of lights. And don't get me wrong, my eyes might not see well, but my mind is super bright, and I'm sure I can help you throughout this journey. Let's set some ground rules here. Rule number one, we are in this together and we do share a single target. What's that target? Getting CSC done. Rule number two, the only thing I need from you is your full focus and attention. Let me take care of converting those 600 plus boring textbook pages into smooth and sweet lectures and exciting journey for you. Rule number three, I have broken down every chapter into small lectures. Each lecture starts with an opening and intro talking about the topic, gives you an idea what we will cover in that lecture. And then you're going to see a slide related to that lecture. And in that slide, we will cover all the details, ins and outs related to that topic and lecture. Rule number four, and the most important one, right after each lecture, not chapter, each lecture, you're going to see a quiz. And please take that quiz. I do have a reason for it. That quiz contains a questions. It can contain 2 questions or 10 questions or 15. Okay, it depends on the topic. But those questions are type of questions you might get on your final test from that lecture. So you may ask, why didn't you put it just after each chapter? Why after each lecture? Because I don't want open tasks in your mind. After each lecture, depending on how easy or hard the lecture was, you might say, okay, I just watched this lecture, I learned everything, but what type of questions I might get from this topic? I want to solve that problem. I don't want any open tasks, any thinking, any wondering, and any guesses about that topic. We're going to close it right away. And please remember, throughout the course, if you have any question about a lecture, a chapter, a quiz, anything, you name it, just message me or ask in a Q&A part. I will respond ASAP. Again, thank you very, very, very much for your trust. And we will get it done together, I promise. Let's just start it. What's capital? I'm not talking about capital of a country. I'm talking about financial capital. Well, capital is wealth. It's what you own, your money, your house, your car, or even your cool video games. For people, businesses, and also governments, capital means all the resources and assets they have. In this lecture, we're going to dive into details of capital. Let's get to it. All right. We mentioned that capital is whatever you own. These assets that you own can be both real, like a house, car. Real things are tangible things. You can see them and touch them. The capital can also be representational, such as money, stocks, bonds. These are intangible capital. The capital of individuals like me and you, and then corporations, and then capital of government, these get together to make the capital of a country, like our country, Canada. The only source of capital is savings. I mean, capital exists in a country because some groups save money in different ways. What are those groups? Like I mentioned, individuals like me and you, corporations, government, and foreign investors and foreign residents. But there is a point here. Non financial corporations, such as manufacturing companies, technology companies, construction companies, are not important providers of funds and savings to the society. But why? Because they keep their savings and money to expand their operation, to add a line to their production, or to hire new people. So they keep it and don't share it with the society. Just like humans, capital also have its own characteristic. Capitals are sensitive, mobile, and scarce. But what do we mean when we say capital is scarce? In simple words, capital is limited. Government and people can't just go and print unlimited money. Why? Because it'll cause inflation. Everybody will have lots of money, then demand for items will be high and prices for that item will go up. We said capital is mobile. What does that mean? If you were a female, would you stay with a man without stable job and income? You may give a chance and stay for a while, but won't tolerate forever and will leave. Just like capital. Capital loves the countries with stable political environment, with a stable financial policies and economic trends. Capital loves it. If a country has unstable political and financial environment, it'll leave that country. When I say it'll leave, I mean individuals and corporations will move their money from that country to more stable area and country. Capital is sensitive. What does that mean? When we say capital is sensitive, we mean that capital is affected by the government policies, different monetary policies. So if interest rate goes up, less people will get loan from banks to buy car and house and stuff, and companies will sell less. So the contribution of individuals and corporations, which both are source of capital and savings, will be a lot less in the financial market. So capital is very, very sensitive to the decisions that government make, monetary policies and fiscal policies. There is a term called investment capital. What's investment capital? The portion of capital designated for investment activities and purposes is called investment capital. This investment can be direct investment, such as buying a house, car, business, machinery, or paying for startup costs, or investing in a new highway by the government. These are all direct investments. Also, there are indirect investments, such as buying stocks, mutual funds, bonds, or depositing your money in the savings account. These are all indirect investments. Good job. Keep up the great work. Remember, we will get this done together. I'll see you in the next lecture. Financial securities are like fancy pieces of paper or digital records that represent some kind of value or ownership. They are used to invest money and earn returns. So you buy them and pay money, and you wait and get profit from this transaction. You, as a future financial advisor or financial planner or investment advisor, you will definitely need to deeply know different types of financial instruments, or the other name is financial securities. Why? Because you are going to invest your client's money in one of these types of securities. How could you do it without knowing the different types? In this lecture, we're going to dive into different types of financial securities. Let's get to it. All right, let's get to it. There are four different types of financial securities: fixed income, or the other name is debt securities, equity securities, investment funds, and the others. So this others include every other securities that are not categorized in the first three types. Let's get to fixed income securities. They're called fixed income securities because they give you a steady, predictable income over time. It's like getting regular paychecks from your investment. Here's how it works. When you buy a fixed income security from a company or government, you're lending money to a company or government. In return, they promise to pay you fixed interest payment, like let's say 6% annually, on a regular schedule for a certain time. That's why this is fixed income. We have three types of fixed income securities, which are bonds, debentures, and money market securities. If I want to explain the difference of these three in simple terms, let's say you buy a bond from a company, and the company promises you that it'll give you 6% annually. If the company, for any reason, can't hold the promise and can't pay you, the company's assets like buildings, machinery, and etc. can be sold to repay you. In other terms, bonds are secured by a physical asset of that bond issuer. Debentures, on the other hand, is not secured and backed with the physical assets. You just have to trust the issuer's reputation and promise. Mostly provincial governments issue debentures, not companies, because people can trust governments, but it is hard to trust just companies. Let's get to money market securities. Money market securities are those which have less than 1 year term. If a company or government has a short term goal that they want to address, short term, I mean less than 1 year, they issue money market securities, and individuals like me and you purchase that security and make small profit. Money market securities are categorized into T bills, commercial paper, and banker's acceptance. Please keep this in mind that this is just an overview, and we will talk about each of these securities in future lectures and chapters. I just wanted to give you a bird view of this categorization. Let's get to equity securities. Equity securities are basically shares of a company that you can buy. When you own equity security, you're buying a small part of that company. There are two types of equity securities, which are common shares and preferred shares. The main difference between preferred shares and common shares is how you earn money and what happens if the company gets into trouble. If you buy a common share of a company, you earn money if the stock price of that company goes up. But if you buy a preferred share of a company, you earn money through receiving dividends from that company. Now, if the company get broke, preferred shareholders have priority on assets. Again, we will dive deeper in the future into these different terms. The third type of financial instruments are investment funds. Investment funds are like a big pool of money that many people put their money into it. This money is then managed by professionals who use it to buy things like stocks, bonds, or other investments to try to grow it. Here's how it works. Instead of one person investing a lot of money on their own, many people contribute to the fund. Then the fund manager decide how to invest that pool of money in different types of securities. There are two main types of investment funds: closed-end funds and open-end funds, or the other name is mutual funds. The main difference between open-end funds and closed-end funds is how they are bought and sold and how their value changes. The number of shares in an open-end funds changes constantly because you can buy or sell shares from the fund at any time. When new investors buy shares, the fund creates new shares for them. When investor when investors sell shares, the fund removes those shares from circulation. This means the total number of shares in open-end funds can go up and down depending on how many people are buying or selling. The number of shares in a closed-end funds is fixed once the fund is created. When the fund is launched, a specific number of shares are issued to the investors, and this number doesn't change. After that, investors buy and sell shares on the stock exchange, but the total number of shares in the fund stays the same. The price of these shares changes based on market demand, but the number of shares doesn't increase or decrease. Open-end funds or mutual funds can be categorized into different types of mutual funds, like 7 or 8 types. But here we just listed the most popular ones, which are equity mutual funds, fixed income mutual funds, and balanced mutual funds. Let's get to type number 4, others. This include derivatives, ETFs, segregated funds, hedge funds, PPNs, and lots of other different types that we couldn't categorize in the first 3 types. Wow, what a long lecture. Remember, we're gonna dive deep into each of these securities throughout the course, so no worries at all. You're doing a great job. Continue and we will get it done together. I'll see you in the next lecture. We have heard the primary market and secondary market a couple of times so far. The primary market and secondary market are two stages where stocks and bonds are bought and sold, but they work a little differently. In primary market, new stocks or bonds are created and sold for the first time. Companies or governments sell these securities directly to investors for the first time in primary market. After the stocks or bonds are sold in the primary market, they are traded between investors in secondary market. This means you're buying and selling already existing stocks or bonds, not new ones. In this lecture, we're gonna dive deeper and know more about these two financial markets. Let's get to it. All right. Like I said, in primary market, people, individuals, corporations trade new securities. just hot and just released securities for the first time. When you buy mutual fund shares, you're buying them directly from the mutual fund company. The mutual fund company creates new shares whenever you invest. Since the shares are newly created when you invest, it's considered a primary market transaction. You're not buying shares from another investor, but rather from the mutual fund itself. Let's get to secondary market. People trade already existing securities in this market. Stocks, for example, are bought and sold between investors in the secondary market. The company is not involved in these transactions anymore. The stock exchange, like Toronto Stock Exchange or TSX, are the places where stocks are traded in the secondary market. Let's dive deeper into the secondary market. There are three main types of markets where stocks and fixed income securities can be traded: auction market, dealer's market, or the other name is over the counter market, and alternative trading systems or ATS. In an auction market, buyers and sellers come together and the price is determined through bidding. It's like an auction where buyers offer prices and sellers accept the price, accept the best price. The stock is sold to the highest bidder and the best offer is matched. So the price is set through competition between buyers and sellers. We know that the stocks are traded in auction market. In a dealer's market, there are investment dealers or market makers who buy and sell stocks for themselves. Instead of matching buyers with sellers directly, you buy and sell from the dealer at the dealer's quoted price. We know that bonds are traded in dealer's market. Let's say you're looking to buy bonds. You won't find bonds on a public exchange like stocks. Instead, you'll likely trade them in a dealer market. You go to an investment dealer who already have the bonds. The investment dealer posts bid or buy prices and ask or sell prices for bonds. And trades are made through a computer network or by brokers. Investment dealers in this scenario acts as principals, meaning they buy and sell securities for their own account and inventory, unlike auction market where they only facilitate trades. Dealer markets are sometimes called unlisted markets because they don't involve securities that are listed on an exchange, like stocks on the TSX. Many smaller, riskier companies trade in these markets. So, we know that bonds are traded in the dealer's market or OTC market. And we said that unlisted um, stocks or securities are also traded in the dealer's market. You can buy or sell a stock that's not listed on a stock exchange in dealer's market, in the unlisted equity market. Trading works much like bond trading. Investors don't directly place their orders in a centralized exchange. Instead, investment dealers act as market makers, quoting prices they're willing to buy or sell at. Your dealer will check the market maker's prices, choose the best price for you, and then complete the transactions. Dealers make money by charging a commission for this service. The third type of dealer's market is OTC derivatives market. A very specialized part of the OTC market is OTC derivatives market. Here, large international financial institutions such as banks trade derivatives products with other institutions or corporate clients. These products are customized to meet the specific needs of the buyers and sellers, adding complexity to the basic properties of options and forwards. We will definitely get into derivatives in details. This is just an overview here. The OTC derivatives market operates 24 hours a day and trading happens electronically without the need for face to face negotiations. Now, let's get to ATS. In addition to traditional exchanges and dealer markets, Canada also has alternative trading system or ATS. These are electronic platforms where buyers and sellers can match their trades automatically. ATSs can provide trading services for both equities like stocks and fixed income securities like bonds. It's like a private marketplace for trading stocks and bonds. Instead of going to a big public auction like a stock exchange, people use an ATS to trade in a more private and often less visible environment. ATSs match buyers and sellers without showing all their offers publicly, which can help with privacy and sometimes lower market impact. There are two types of ATS markets: equity electronic trading system. Here, ATSs in the equity market serve a similar purpose as traditional stock exchanges, but with some important differences. ATSs automatically match buyers and sellers instead of relying on a floor of brokers like in the stock exchanges. And ATSs cannot list securities like traditional exchanges can. They only trade securities that are already listed in other exchanges. Let's get to fixed income ATS. F- uh, when it comes to bonds and money market instruments, the majority of these types of securities are traded through dealers market or ATSs. There are four platforms in Canada that deal with these types of securities in ATS. CanDeal, an ATS operated by Canada's sixth largest bank owned dealers, providing access to government securities and money market instruments. CBID, this platform operates two distinct marketplaces for bonds: retail and institutional. It's designed to give both individual investors and institutional clients access to bond trading. Market Access, another ATS that focuses on corporate bonds and offers competitive pricing from multiple dealers. CanPX, a joint venture that aggregates real-time bond price information, particularly for Government of Canada bonds. All of these four platforms facilitate private trading of fixed income securities mostly. Wow, what a large topic and lecture. You did a great job. Please keep going and remember, consistency is the key. I will see you in the next lecture. Imagine you are at an auction where buyers and sellers gather to buy and sell items like artwork or antiques. In the world of finance, that item is a security, such as stocks or bonds or other investment products. The place where these buyers and sellers meet to trade securities is known as exchange. In this lecture, we're going to know and compare different exchanges available in Canada. Let's get to it. Okay, we're going to compare 7 different exchanges operating in Canada in different factors. What are those exchanges? TSX or Toronto Stock Exchange, TSX Venture Exchange, TSX Alpha Exchange, Montreal Exchange or MX, ICNGX Canada, Canadian Securities Exchange or CSE, and NEO Exchange or NEO. Let's start with focus. Toronto Stock Exchange or TSX focus on senior equities, equities that are already have been there out there for lots of time and have lots of good history. So senior equities. TSX Venture Exchange is for junior equities. TSX Alpha Exchange is for high-speed trading. The focus of TSX Alpha Exchange is high-speed trading. Montreal Exchange is for derivatives trading. ICENGX Canada is for natural gas and electricity trading. CSE is for small cap and emerging companies. And NEO Exchange is for innovative companies and ETFs. So each of these exchanges focus on a certain type of security. So we need to differentiate between these. Let's go for securities. What type of securities are traded in each of these 7 exchanges? Starting with TSX. Equities, ETFs, income trusts are traded on TSX. On TSX Venture Exchange, equities and ETFs are only traded. On TSX Alpha Exchange, equities high-speed trading focus. So remember, the keyword for TSX Alpha Exchange is high-speed trading. So high-speed trading of equities. On Montreal Exchange, options, futures, and swaps are trading. On ICNGX Canada, natural gas, electricity, and crude oil are being traded. On CSE, equities, ETFs, and debentures are trading for small cap and emerging companies, of course. On NEO Exchange or NEO Exchange, equities, ETFs, and structured notes are trading for innovative companies. Let's go to target. What type of investors can buy and trade in these type of exchanges? Starting from TSX, both institutional and retail investors can trade here. In TSX Venture Exchange, growth stage investors, those who are not risk averse, who have a higher risk profile. In TSX Alpha Exchange, high frequency traders. MX is for derivatives traders. ICNGX Canada is for energy market participants. CSE is for retail and small cap investors. And NEO Exchange is for institutional investors and ETF focused traders. Let's go to geography. What type of securities from what country is being traded on these different exchanges? Starting from TSX. TSX is global with a strong Canadian focus. So most of securities are Canadian, but we do have some global securities. TSX Venture Exchange is Canada-centric with some global listings. TSX Alpha Exchange is primarily Canada. MX, Canada, US, and international derivatives. ICNGX Canada is focused on North America. CSE is focused on Canada. And NEO Exchange is focused on global. Let's get to highlights. What's the key point about these 7 exchanges? TSX is the largest and most liquid market in Canada. So remember this, TSX is the largest and most liquid. TSX Venture Exchange is a gateway for small and mid-sized companies. TSX Alpha Exchange designed for high-speed trading. The keyword here is high-speed trading. MX or Montreal Exchange is Canada's only derivatives exchange. ICNGX Canada is energy-focused market. CSC is fast listing process, lower costs. It's for, as we talked about it, it's for small cap and emerging companies. And Neo Exchange is focused on innovation and fair access. You did it. You're doing great. Keep up the great work. Please go and take that quiz and test your knowledge. I will see you in chapter 3.